So going over NPV and capital budgeting, with NPV and capital budgeting, what we're always look at is what is the present value of a set of cash flows at a later time. So the investment we put in is negative, and then the cash flows that are coming in later is positive. The terminal value is what is something worth at a later time. So these are true cash flows, and then terminal value, I think in this example, they're simply saying with this drug, they're going to get these exact cash flows and then they're going to sell that drug to another company for 500 million. So that's the additional value. So with that said, this is simply the present value of the future cash flows. And given that we put in a billion, I believe, and then we're getting 1.207 billion back, the net present value is 207 million, which really means that this is risk rate of 8, that we have a positive investment. Even after discounting everything by 8% a year, this is positive. So we paid a billion for this, and we're getting on a discounted basis more than we had paid for. So this is a good investment. And that's why you look at NPV. NPV is really to evaluate if what you put in versus what you're going to come out on a discounted risk-adjusted basis is more than zero. And in that case, in other words, you're creating net present value. This is the note from Harvard Business Publishing, and I wanted to show how to use this illustrator here. And this shows you what would happen if you invested 1,000, and then there was $1,000 of cash flows for each of the 5 years ahead. And what you can kind of see, okay, so say our investment was 2,500, the cash flows are still 1,000, and you could see when you hit run, we have a positive present value. But if, say, you increase the risk rate to very high, then that present value basically goes down, because the higher the risk, the lower your adjusted cash flows will be. So you can kind of test and see, be like, oh, well, what would cause this to be negative, because then you shouldn't invest. So if your investment, for example, is, okay, so once you start going beyond 3,300, your net present value starts going down with this basis, okay? But you can have this idea of lowered risk, and lowered risk increases your basis. And this is really the idea we're trying to grasp is, lower risk helps you to have higher net present value, right? So you always want to lower your risk of your investments, okay? Higher cash flows, lower investment increases your value. So the less you have to invest to get those same cash flows, obviously you're going to have more value. So you always want to spend less money and have it be at a lower risk. And that's, some of the things that are driving this thing beyond the main concept, which is you want to have an investment and adjusted cash flows to see what the net value is.